Okay, hello everyone, and thank you for joining us today for Money Show's Powerful Investing and Trading Strategies Virtual Expo. Unfortunately, Avi Gilbert couldn't make it today, so I'd like to introduce you to Zachary Manns and Garrett Patton of Elliott Wave Trader. Mr. Manns is co-host of the Stock Waves and Mining Stocks service within ElliottWaveTrader.net, providing wave alerts and trade setups on individual stocks, as well as the Miners Model Portfolio. He also co-hosts the site's weekly Beginner's Circle webinar for new members. Mr. Patton is a technical analyst and chief educator for ElliottWaveTrader.net. His focus is primarily on equity futures and demonstrating the capabilities of unconventional technical analysis. The chat is open in case any of our audience members have questions, which we'll address towards the end of the presentation, time permitting. I'm sure we're all eager to get started, so without further delay, I'll leave you in the capable hands of our speakers, and I'll be right here in case you need anything. Zach and Garrett, I'm going to stop sharing my screen, and the floor is yours.
Thank you so much.
Thank you.
There we go. So as mentioned, we are filling in for Avi Gilbert, who couldn't make it today, but work with him closely, contributing on the regular markets section of ElliottWaveTrader.net, as well as Garrett and I co-hosting Stock Waves and the Metals, Miners, and Agriculture service. So we're going to present today on a very similar topic to what Avi was going to talk about, clues as to know when the potential end of this major bull market that has been going on for quite some time, and what to look for. And so we're going to kind of add in a little bit of our own flavor that we see coming from the stock wave side, but talk about the broad market indexes within an Elliott Wave frame of reference. To give you guys just a very, very quick crash course for some of you who might not be familiar, Elliott Wave is a school of technical analysis that looks for recurring fractal patterns of investor sentiment. So one of the things that Garrett and I like to say is that it can put other types of other technical analysis tools or other patterns that technicians might be seeing, such as an inverse head and shoulders or other trendline breaks, but put those into context that makes sense from, at multiple different degrees, that can look back on historic charts and also project things into the future because of the way that those patterns unfold. So basically, Elliott Wave can be divided into motive waves and corrective waves. Motive waves are going to advance the direction of the trend. Corrective waves are going to go counter trend or retrace that advancement. Most of the time, those are going to divide into a set of 5 numbers, whether it's regular Arabic numerals or Roman numerals, and the letters A, B, C. With some exception that gets a little bit confusing if we get into that. Within a motive wave, there are 2 main types of motive waves. Those are impulses, which are the more strong, really trending moves, momentum type moves. And then there are diagonals, which do advance the wave structure and have some of their own unique characteristics, allowing for overlap in the 4th wave, all of the subwaves being composed of ABC moves as opposed to impulsive 5-wave moves for waves 1, 3, and 5. And we use those, knowing which type of structure you're in can be very helpful in allowing you to know what type of price action you should be able to see at smaller degrees within that structure. The primary advancement that I think that Avi contributed to Elliott Wave was his discovery of Fibonacci pinball. R.N. Elliott gave us some very good guidelines of some different Fibonacci ratios that different parts of an Elliott Wave structure might see to each other, such as typical retracement levels for the wave 2 or some typical extensions overall for the wave 3. But what Avi found was that, use my little pointer here, was the subwave structure within a 3rd wave followed some very specific guidelines itself. This wave one, the lowercase Roman numeral one, is the subwave inside this Arabic numeral wave three in this example. That wave one would typically target the 382, the 0.50, or the 0.618 extensions, and those are fib extensions as the measure of wave one projected off of the low for wave two. Then after getting a normal retrace to the normal fib retraces that we typically see for a wave two, then you'd get a third wave that would go to either the 100% or the 1236, normal retracement levels based on a number of different guidelines for wave four, and then an extension for the fifth wave of wave three, either to the 1382 or in this case, the 1618. And that happened with such frequency that Avi really coined it Fibonacci pinball. And then you can get a normal retracement again for the wave four at this degree, and then use the same Fibonacci extension to target either the 1764 or the 200% extension for the remaining wave five, which also should be composed of 5 subwaves in this case. So we use those Elliott wave guidelines and Fibonacci pinball, as well as looking at lots of different charts and different indexes and how the indexes might diverge from each other. And we'll talk about that a little bit, to give us a very clear picture of what the markets are doing. We also place a lot of emphasis on education on our website and have a lot of materials available on Elliott wave theory that are available for free. And you can use the QR code here. Now, for the next segment of the presentation, I'm going to let Garrett talk a little bit about his long-term chart here on the S&P that uses data going all the way back to the 1800s.
Thank you, Zach. So as you can see, this is a very long-term chart. Each small little black bar there is a 3-month period. So this is going all the way back to really the Civil War period, which is where we're starting this larger degree super cycle Elliott wave count from that low. So from that low, we had a leading diagonal supercycle wave one into the 1929 high, and then that Wall Street crash from there into the Great Depression low in the 1930s as the supercycle wave two. And since then, we believe we've been filling out and are nearing completion the supercycle wave three within that larger degree structure. So going back to the 2000 tech bubble, we believe that is where the wave three, remember the fractal nature of Elliott wave theory, these larger degree subwaves themselves should subdivide into smaller 5-wave moves. So that tech bubble top in 2000 completed the wave 3 of 3, the cycle degree wave 3 of the supercycle wave 3. And then we had the correction fill out into the Great Recession low in 2008, 2009 as the cycle degree wave 4. We believe we are nearing completion of the super cycle degree wave 5 off of that 2009 low. And as you can see, the smaller degree subwave structures, even within that super cycle 5 from the 2009 low, the COVID crash in 2020 is where the primary degree wave 4 within that cycle degree wave 5 completed. And we do believe we are nearing completion of the primary degree wave 5 within that supercycle wave 5. So completing the supercycle wave 3. So the correction that we're anticipating, which is approaching, is the same degree correction as the wave 2 at the Great Depression low. Now, one of the guidelines of Elliott wave theory is we typically expect alternation between the wave 4 and the wave 2 of an impulse. So the correction that we got into that Great Depression low was a very sharp, swift drop to the downside, which we refer to as a zigzag within Elliott wave theory. So we're not expecting the same very sharp crash type move as the supercycle wave 4 correction. We should expect some alternation and probably something that really drags out a lot longer in time and creates more of a sideways flat structure is what we refer to it for that wave 4, even potentially a triangle. So as you can see, this is just kind of a tentative guess at the moment, but I even think we could see a new all-time high in the B wave of that supercycle wave 4 while still being within the larger correction, kind of similar to, you can't really see it on this chart, but the primary degree wave four into the 2020 crash, the B wave within that wave four into the 2019 high, I guess it was early 2020, made a higher high compared to the primary wave three as an expanded flat structure. So kind of a similar type move, just at a much larger degree for the supercycle wave four. Again, just a tentative guess for the moment. There are many other options we can consider. We will obviously weigh those options as we see more of the price structure fill out.
I think the 2007 high was also nominally higher
Nominally
than,
high. Yeah, it was.
than
You are
2000.
correct.
Just not as amplified as the early 2020 high in some of those charts. So this is the next slide here is a more detailed view of just that cycle degree wave 5 off of the 2009 lows that Garrett was just discussing, with an overlay of kind of the typical cycle of sentiment, so that you can kind of see that matched up with the different subwaves within that structure. And then an overlay of the corrective cycle at a larger degree. So you can see the normal corrective cycle of denial, fear, panic, desperation, and capitulation. I have here overlaid with just that possible A wave that Garrett was talking about within the super cycle parentheses wave 4, that would be further out potentially if this is going to alternate. There's a couple of ways that fourth waves can alternate from the wave 2. As Garrett mentioned, they can be a wider and higher flat consolidation as opposed to a sharper, abrupt zigzag. And they can also just be a much bigger correction based on time as well, and maybe being something like that triangle that plays out. But at the very minimum, we're looking for a move down towards at least the lows from 2020, if not somewhere in the region of 2012 to 2013, as kind of the first support level that would normally at least just be an A wave. Even if we don't ever get much deeper than that, that should be a pretty sizable move down. So it's certainly something that needs some preparation and some awareness of. We talk a lot about risk skew whenever we're evaluating things for the market. And, we're getting very, very close to the end, but we are going to talk about some of the potential paths and things that we see that could go higher, and the paths for the market to head higher, and where some of those important support levels are going to be for signifying a possible more significant top.
Right. And as Zach said, we're not trying to really peddle doom and gloom here. We're just kind of showing what is a potential based on that large degree Elliott wave count, not suggesting that everyone go tomorrow, sell their entire portfolio and either short the market or go into complete just cash position. We, for one, don't have evidence of a local top in place in this more recent uptrend off of the October low. Even though it does seem fairly stretched, we're seeing a lot of negative divergence based on technicals. The smaller degree subwave structure does look like it, is pretty full within those smaller degree subwaves to be nearing completion of the next local top. But we're going to give price the opportunity to attempt further extension, based on the merits of that price structure. So you can see here on the daily charts that one of those possible larger degree options for further extension is that rather than completing all of the fifth wave off the 2022 low within that larger primary wave 5, this could be just a larger wave 3 of that fifth wave. So still decent sized correction, probably similar to the correction we got from the July high into the October low for a wave 4, and then maybe an attempt for one more higher high from there, which I'll show at the end. There are a couple of sectors that could match that expectation.
And I think one of the important things to point out here is that because we did get extension past, any immediate downside setup that we might have seen off of July, we got a nice possible 5-wave move down, but it didn't hold resistance on the bounce we were looking for. So we got our nice extension in more of this fifth wave to new highs. So because we did get a fifth wave to new highs in most things, we'd be restarting any potential correction from scratch. And so whether this is an A, B, and a C wave down that is the wave 4, or just an A wave and the start of a bigger A, B, and C wave drop, there'd still be good potential for at least a corrective bounce of a good 5% or more off of a possible support in the 4,700 region for a move back up into the 4,900 to 5,000 region as a corrective bounce. And that corrective bounce could, of course, be the A wave, because this would be a larger diagonal, the A wave of this move. So we'd be expecting the same kind of structure off of that low, even if it's starting this fifth. We'd just be looking for it to hold a corrective retrace from there, versus if it was a more significant top, we'd be starting something of a more impulsive drop. So you can maintain, I think there's sometimes Elliott wave gets criticism for having alternate scenarios, but I think understanding why we view those alternate scenarios and where they line up with each other is incredibly helpful. So yes, there's, a potential for a major top to be in place sooner, or for support to hold and a move higher. But the structure that we anticipate seeing should be very, very similar for both of these up until about this point right here.
And even at the smaller degree, as we approach this next potential local top, it does look like there is room for further subdivision higher, especially after the breakout that we saw following the FOMC announcement this afternoon, which has exceeded now the previous March highs. So it does look like we need at least another 4 or 5 in this potential diagonal off of the low that was made Monday of last week. As you can see in the chart, it could even reach a little bit higher in that smaller degree wave C of 3 before this next smaller 4 or 5. Again, before the next local top is attempted. So really, as far as providing some initial evidence that price is putting in that local top, we'll need some evidence of a trend change, basically some lower highs and lower lows of significance. And that really starts with a break back below the lows that were made this week, the lows that were made last week, and eventually back below the February lows.
The next chart we wanted to show you guys was there's some discrepancies, not discrepancies, but some nuanced differences between the tech sector and the NASDAQ and sector ETFs like XLK and SMH, and the S&P 500 itself. And, some of that is fueled that some of the big names in the tech sector are part of the Magnificent Seven, which fueled a lot of the extensions higher over the last year or so in the broad market. And we'll kind of take a look also later on in this presentation at the equal weight index that we like to use a lot, that kind of smooths out some of that possible, some people might view that as distortion. It's a little bit harder to count this, I think, as the same possible wave 3 and looking for a 4th and a 5th wave as far as further extension, but that too is also possible. XLK does count very similar to this and looks very, very complete as a clean ending diagonal, which does still have room for some squiggles higher, but has some potential. And also NASDAQ today did not make a higher high yet, as ES did. So there is still some potential that could be a lower high forming and try and retrace a little bit more, and especially if ES gets a little bit of a deeper 4th wave that Garrett showed you on the previous slide. The other thing that's very different on the NASDAQ is that the low that it made in 2008, 2009 was a higher low from what it made in the earlier 2000s after the tech bubble burst. And so that structure makes this look more like a cycle degree 3rd wave in the NASDAQ. And so it's looking for an ABC move down, pretty big sizable correction, but that ABC at a primary degree for the cycle degree wave 4 might line up very, very well with just the A wave that we looked at on the larger degree charts for the S&P. And that the 5th wave, the cycle degree wave 5 that we could see from there, could be the major contributing factor to that cycle degree B wave in the S&P, making that higher high that Garrett mentioned is as the expanded flat. So there are a number of tech names that we're still bullish on, but seeing a lot of potential to rotate maybe away from some of the semiconductors and into some other things, and a lot of potential weakness as soon as support breaks. Let's I think I already mentioned your 4-5 here.
Yeah, we don't really have to spend much time on this chart, just showing the same potential of the
Right.
Another 4-5 within that diagonal for the
Right.
NASDAQ as well.
The other chart that we wanted to show you was the Dow Jones. This is the YM futures. And this is one where the consolidation that we saw into the October 2022 lows was not quite as deep as it, relative speaking. It still was at a 618, but that's kind of normal because we are counting this as an ending diagonal for the primary wave 5 as opposed to an impulse. Where this was a larger ABC up for wave 1, an ABC for wave 3, and we're expecting that deeper consolidation to hold around the 618 for a larger wave 4, and then looking for an ABC for the 5th wave up to complete. So we do have an ABC up, nicely higher than the parentheses wave 3, and that has 5 waves up, very close to looking complete in the C wave. Again, some room for, at the smaller degree, for some potential extension higher, but one chart that is pretty concerning and starting to see some significant divergence here on the daily MACD. Another index chart that we look at a lot that is very, very noticeably divergent from all of the others is the small caps, the Russell. This is the RTY futures. The C at the end denotes that these are all back adjusted because with interest rates higher, the gaps between when the contracts roll make a bigger difference. So I switched over to using the back adjusted on all of my futures charts. But here we have an expanded flat. That's where the B wave inside this B wave made a lower low, and 5 waves up, completing into very, very normal Fibonacci resistance for a corrective retrace as a completed primary wave 5 already, and an A and B structure in the start of a bigger move to the downside potentially. So there is potential for another extension up towards the 2200 region, but a very, very concerning chart. And I think one of the characteristic things that somebody, I forget who pointed it out, I probably saw it on Twitter, but that when you have names that start to do very, very well in the small caps, like the most recent one, SMCI, when they do too well and grow too big, then they cease to be small caps and they get graduated into one of the other indexes, and they no longer benefit and help out the Russell. So SMCI was the most recent one, but it does tend to happen a lot, and then you're left with a greater percentage of less favorable looking charts.
And I think it's worth noting before switching away from this chart that we did see something pretty similar, the same divergence when right before the COVID crash, when that orange B wave there, when the Nasdaq and the S&P 500 were making higher highs compared to the highs, I think it was 2018. Back in 2020, before that COVID crash, the RUT, the small caps were not. They still very much looked like that B wave within the wider flat primary wave 4 to set up that Z wave down that we saw obviously fill out in a very swift fashion during the COVID crisis.
Right. And I think that there's certainly plenty of opportunities for some smaller cap names that we see within stock waves. And, people have said, how can you be pointing out bullish opportunities when you're, seemingly so bearish on everything else? And, the way that we address that is we say, we say each chart on its own. First and foremost, there's also no support, no key supports have been broken since we got the extensions starting in November, and so things can continue to extend, and maybe some of those smaller cap setups that we see in stock waves are going to help provide some fuel for that extension. And the other thing is that those setups, if we do get sort of the start of a bigger downdraft and Russell's one of the things that could be, C waves tend to be, Avi refers to them as crash waves, that's the impulsive part of a corrective move, because a C wave is going to be a 5-wave move to the downside. So it has the potential of being a sharper, more abrupt drop. So if we were to see something like that, particularly coming from the Russell, that would likely invalidate some of the good-looking bullish setups that we do see. So it's very important to be aware of key support levels and invalidation levels and always be using stops. So that brings us to the equal weight that we mentioned before. And this is kind of, the way that it counts is almost a hybrid between the Dow and the S&P itself, where it allows for this to be the 4th wave of an ending diagonal, similar to what we were counting on the Dow. And so this A, B, C up, instead of being a B wave like we have on the Russell, and it certainly can be the B wave. I think both of these are perfectly valid wave counts, can also be that 5th wave of the primary 5th wave extension. But very much like we have in the Russell and in the Dow, off of that more recent October low, we can count 5 waves up, trying to complete, with some potential for further extension towards the 168, 169 region in the RSP, but getting pretty close to the normal extension level. And we did hit a 100% extension already, and do have that 5 waves up, completing off of the October low. Do you have anything you wanted to add on this, Garrett?
No.
All right.
So again, we're not bearish in everything. We do see some individual sectors that can diverge from that large degree expectation that we showed for the indexes. And one of the main sectors that we have been staunchly bullish on since the 2020 low and continue to see the potential for outperformance is the energy sector. So as you can see, if you remember that very long-term 100-year chart on the S&P we showed at the beginning, that is completing the cycle degree wave 3, wherever the next high ends up completing. When looking at the very long-term chart for the energy sector, it looks like that cycle degree wave 3 completed back at the 2000 and it's either 7 or 8 high, completing the cycle degree wave 4 into the 2020 low. So price filling out 5 waves up from that low, where it looks like now we're seeing a lot of the individual stocks start their wave 5 within that larger 5 up, can be a cycle degree wave 1 starts to the super cycle degree wave 5. So even near term, we do see some potential for outperformance from the energy sector and maybe decoupling with the rest of the market, kind of similar to what we saw in 2022, to get that primary degree wave 5 to the upside, complete that cycle degree wave 1. Decent sized correction from there in the cycle degree wave 2, but this could continue to decouple from there from the rest of the market if at that point we have started the large degree super cycle wave 4 correction in the indexes.
So the next chart that we decided to include is a ratio chart that is a comparison between the S&P and the gold futures. And so this goes back to a high that was made. So ratio charts are interesting, and especially when sometimes they seem to show trending potential, and they do exhibit some nice Elliott wave subwaves. But we treat them a little bit with a grain of salt. But also, it's important to know that a ratio chart is not showing a particular direction for either of the instruments. It's just showing relative performance based on the patterns that we're looking for. So this represented a pretty significant high for gold in 2011, and the market was still not yet so high off of the 2009 lows, but off of that we can fill out a nice 5-wave move complete, and within that 5th wave can count a fifth wave potentially complete. There is some room for a little bit more extension in what would be the A, B, and a C wave of the fifth. Could even get a little bit deeper as a fourth wave and then get a fifth wave up. But there is certainly potential that this is starting a larger retrace that can take the S&P to gold ratio closer to possible parity over a bigger ABC move over the next 5 years or so. So we are certainly bullish on gold from here, and can see gold heading up into the 2400s to 2500s and maybe even higher, depending on how that pattern plays out. And could certainly see, we've already looked at charts that show the S&P that can possibly get a corrective retrace down into that region as well. Same 2500 region, or maybe holding closer to 3000.
So this is the S&P 500 gold index chart, also showing larger history. It doesn't show all of the prior history, but you can kind of see, similar to the energy sector chart, that we have the potential for that same supercycle wave 3 to be complete, in this case back in 1996, and a large expanded flat supercycle wave 4 that completed at the low that was made back in 2015. The start to the primary, the supercycle wave 5 looks like, based on the price action so far, that it will be as a larger ending diagonal. So that ABC up is the cycle degree wave 1, and a nice 3-wave ABC structure that has just recently tested the 618 retrace for the cycle wave 2 that is starting to give us some initial evidence of being complete. This index is pretty heavily weighted, the S&P 500 gold index, in NEM. So it's a very similar pattern on that specific stock, and that's also the highest weighted stock in GDX. The potential for the wave 2 to complete needs a little bit more confirmation off the low, but again, we're seeing some nice constructive price action from individual mining stocks from that February low, as well as gold trying to break out to new highs as well. Another area of the market that we see some potential for outperformance and potentially decoupling from the rest of the indexes that could be entering into that large degree correction and bear market is airlines, and more broadly travel stocks. The airlines index, when we look at the much larger degree count, does have the potential setup, especially if it can hold the recent low that was made, I think it was earlier this year, as that wave 2, to be continuing back above the 2017, 2018 highs in this wave 3 of that larger C wave. So going all the way back to, I think it was the 1930s lows. This can be a larger diagonal structure. Working on the cycle wave 5, we have the A wave, the B wave in place, and what looks like a 1-2 start to the C wave, again, if we hold the recent low. Aerospace and defense is another individual sector chart that does look like it has the potential for further upside. Now, not quite as dramatic or sustained compared to, say, the gold chart or the energy chart, or energy sector, or even the airline sector. In this case, it just looks like it's working still on the 5th wave of the large degree 5th off the 2020 low. It does not yet look complete, when it looks like we are closer to potentially completing that in the indexes. So we could still get a near-term pullback as what would be wave B of 5. This is another diagonal structure from that 2020 low. But we do think that there is the potential to continue higher, at least into the end of the year and maybe into next year, as the rest of that 5th wave for aerospace and defense stocks. The financial sector also has the potential for further subdivision before its respective 5th wave completes, the wave 5 of the larger 5th off the 2020 low. And this is what I was mentioning earlier when we were looking at the daily chart for the S&P 500, the daily chart for the NASDAQ, that red 4 and 5 in the larger diagonal off the 2022 low. This is one of the sectors that can match that expectation, completing wave 3 of that diagonal soon. It looks very close to completion of that circle wave 3. set up a wave 4 correction. That would still be a pretty decent sized drop, but the potential for another high to follow from there as long as that circle wave 4 holds support.
How much is JPM in the weighting of this S&P financial sector?
I assume it's either one of the top weightings, if not the top weighting.
Right. Yeah, it looks
Maybe
very,
BRKB might be the top.
very similar.
XRT, we recently did one of our sector reviews that we do every Thursday in the Stock Waves service on the retail ETF XRT. And when we went through a lot of those individual charts, there happened to be quite a few that did look like they still were holding well within bullish patterns to see further upside into the end of the year, maybe even beyond there in the most bullish of those potential charts. So another situation where this specific sector seems to match that red count from the daily SPX chart, another 4-5, which in this case would complete that wave CFB. So we're not expecting a new high above the 2021 high, but the potential for further subdivision, one more 4-5 in the wave CFB here.
This was one though that it is important when you're not to rely on some of these fourth waves to hold. That this is where you raise some cash and play defense, looking for a clear ABC correction for that fourth wave, which could be pretty deep. And because and I mean, it shouldn't overlap. But there are some of the charts that we looked at that look more like this could be an ABC up for a Y wave, completing all of this B wave as just a more shallow flat at the 100% extension. And so if we were to see a 5-wave move down instead of a clear ABC corrective move for that wave 4, that would be a very strong warning that would imply more of the start of the larger C wave to the downside.
XHP, this is a chart that really could be coming into a very significant top, similar to our expectation for the broader market. But one of those situations where you take a look at the individual stocks within the sector, and there's enough of those individual charts that I think can make a case for potentially being more bullish, and another situation where we could see that decouple from the market. It certainly looks like this should be 5 waves up, and that matches all of the individual charts as well from the 2022 low. So still coming into what looks like a pretty significant local top. But some of those individual charts, that can be the wave 1 start to a larger third wave. Now, we don't normally try to come up for any sort of fundamental or story, any reason for our expected counts based on that technical analysis. But obviously with the housing crisis and the tendency for politicians to just want to build more houses as far as a solution to that, this could obviously benefit if that is where policy shifts even more. We'd still expect it at the very least that red wave 2 correction.
I think that is the end of the slides, so we will open it up for some questions.
Okay, yes, we do have a couple questions. So our first question from Salah is, what do you think for Bitcoin in this cycle?
Bitcoin, it kind of matches the red count on the S&P 500. It looks like we can be either already topped or approaching a top in a third wave in the impulse off of the 2022 low, but it looks like we see another 4-5.
Okay, our next question is from Joe, who asks, so if I heard you correctly, you're saying once the correction starts, we might still see an all-time high in the SPX. Did I hear that correctly?
Yes. So when we were looking at that 100-year chart, and we saw that the same degree correction, the wave supercycle wave 2 into the 1930 low was a very sharp zigzag drop. Again, the fourth wave with an impulse tends to alternate both in time and structure compared to the same degree wave 2. So that very quick, sharp drop as the cycle wave 2 suggests we should expect a more drawn out fourth wave with the potential to maybe even see a new all-time high in the B wave in what would be considered an expanded flat structure based on Elliott wave patterns. Another reason to consider that as a possibility, and Zach mentioned this when we were looking at the NASDAQ chart, because it held a higher low in 2002 compared to the 2000 low, it has an extra possible 1-2. So it can get another 4-5 at the much higher degree off of the 2008 low, which could coincide with that same higher high on the S&P 500 as a B wave within the structure there.
But it is important to note that that's after a pretty sizable primary degree ABC move down for the cycle A wave, which could take the better part of the next decade to fill out. And then that would be a move up that could easily take, its own decade to fill out through most of the 2030s to get that higher to that higher high. So I'm sure we'll be, tentatively looking for lots and lots of bullish opportunities, even if we're not expecting that B wave to go to higher highs. But so come visit us in stock waves in the 2030s, or just, you can get an annual membership as well. Stick around.
Okay, the next question is from Andrew, who asks, will it be impulsive or corrective for the next major move down that you were projecting? How can an ABC correction result in a higher point B than the previous high point 5?
So if we are going to see a higher B wave, then based on our standard expectations for Elliott wave structures, the A wave should be a 3-wave move. So that's what Zach has shown on the chart here, that circle A, B, and C wave to complete the large degree wave A. And usually, I think a 3-wave A wave is more common than a 5-wave A wave to the downside, at least based on my experience. So it's not that we can't see a 5-wave A wave, just it's more common for a 3-wave structure in that A.
Great, thank you for that. We have another question from Joe, who asked, so is the IWM going to start a correction? If so, when in general terms can we expect it?
So in terms of the smaller degree, I think it can fill out more towards the 2200 region if it's going to hold the recent low that it just made. I think it was yesterday.
Yesterday.
Then we can head up towards 2200. If that low breaks, then it can be the start of what would be wave 1 of a 5-wave move to the downside for the C wave starting pretty soon. There's not a lot of clarity in the structure that allows for a deeper 4th wave and then another 5th wave after that. So
Right.
that would kind of be, it's kind of an all or nothing at the moment for that extension. So that's going to be a key level to watch.
I would agree. Break below yesterday's low is your first warning sign, and ultimately below the January low should confirm that top.
Okay, great. And our next question from John is, stops are paramount during this potential SPX topping pattern. What is your SPX cash stop level on equity longs? A break of what level says downside potential has a higher probability?
I mean, that really depends on your own risk tolerance, how much you want to give room for any further extension to the upside. Yes, as we were looking at this hourly chart for the ES, the very first invalidation of any further upside is a break below the low that was made pre-market yesterday morning, then below Friday's low, then below last Monday's low. Then you take out the previous March lows, and previous February lows really should solidify that larger top in place. So again, it's just kind of a option of how tight you want that stop.
But it's also important to note that, even if we're not getting the 4th wave, even if we're starting something as a larger correction, as we mentioned before, this is probably going to be an ABC move down into this same support region, even if we're starting a bigger correction. And that A wave of the ABC for the wave 4, as Garrett mentioned, most A waves tend to be ABCs themselves. So it's going to be a smaller A, B, C move down for that A wave. And within that, we'll be able to look at that smaller degree. And that's what we do all day long in stock waves and in the market service on EWT, is we're just cycling through those charts and looking at all of the smaller degrees to see how they line up and mesh with what our expectations are at the larger degrees.
Right. And if you're referring to individual stocks, respective support and validation levels on each of those individual charts is going to be different. So they should be treated based on their own merits.
Great, thank you for that answer. Our next question is from George, who asks, I believe that you envision GDX going up big time. Why won't GDX be seriously dumped in the upcoming big general market fall?
Again, we're basing that expectation on both that large degree gold index chart that suggests a cycle 1 to start to a super cycle wave 5 can be in place, trying to start that wave 3 again. We don't have a whole lot off the February lowest confirmation. It does look like 5 up on a lot of charts. Gold is trying to break out to new highs, so we're seeing some good initial evidence that the bottom can be in place. Still want to see more confirmation overall, but this is based on, again, the individual patterns on both GDX, on gold, on other precious metals charts, on the individual mining stocks themselves, that all seem to align with that large degree bullish potential. Now, if we, see specific support levels or invalidation levels start to break, then that obviously changes that perspective or that expectation. And yes, in a situation where we see a vacuum of liquidity, kind of similar to the COVID crash, that can cause contagion and really lead to, markets all over the place starting to fall apart. But we don't necessarily expect the initial drop from a high to be crash-like on the S&P 500. It actually could be a fairly orderly sell-off, kind of similar to the path that we saw to the downside from the 2022 high into the 2022 low, with a lot of up and down overlap.
And I think it's also important to consider with regard to, we try and avoid arguments about correlation. You can see here between 2011 and 2015, the GDX had, the gold index and GDX also had a pretty massive move to the downside when the market was soaring. So there are a lot of people that argued for an inverse correlation, but then all of a sudden that inverse correlation, ended and they went up together. So we would rather look at the subwave structure and look at the other, factors that Garrett had mentioned for each of those charts, and not try and argue that this is either an inverse of the market and a direct result of outflows from the market going into the gold index, into the precious metals, and the miners, but just its own phase and cycle of sentiment that we're watching for the ebb and flow of.
Great, thank you for that answer. We have another one from George, and we'll try to get through a couple more before we run out of time, who asks what your targets are for uranium.
I think we look at the URA and we look at a lot of individual uranium names in our metals, miners, and agriculture service. And we also look at URA in stock waves in general. We're pretty bullish long term. I don't know what that translates to in terms of the actual uranium price, but a lot of them look like they should be getting some more consolidation in the near term. And some of them can be a pretty substantial amount of consolidation, although still overall long-term bullish.
Okay, great. So this one's a little long, so I'll try to go quickly through it. But Robert asked, this presentation differs a bit from past Elliott Wave presentations I've seen or heard in the past from your lead EWT analyst in your company, where as soon as 2023, 2024, that we would be entering a period of a multi-decade bear market based on EWT. But I probably jumped the gun, as I do see that Zach's black chart shows this in more detail than Garrett's white chart shown at the beginning of this presentation. Are we at the point that the old type of investing by buy/hold in a VG S&P 500 index fund? Will this presentation will this presentation be recorded for only for EWT members? So to answer your second question, Robert, this presentation will be on the Money Show website and YouTube channel. But for Zach and Garrett, the question is, are we at the point that the old type of investing by buy/hold in a VG S&P 500 index fund?
I don't think Garrett and I have ever been like a fan of just buy and hold a Vanguard S&P index fund. In general, we as the hosts of a service that focuses on individual sectors and individual stocks, we're much more in favor of building your own portfolio and buying and selling as things get to targets and looking for rotation opportunities. And I don't think that needs to change. I just think that the awareness of the larger degree risk skew and knowing that things could be trending down in general for the next foreseeable future after we do actually start to confirm a top is important, but there's going to be plenty of bounces where if you are not one who's in favor of directly shorting the market or individual stocks or sectors, you can just look for those corrective moves down to get to a point of support and then look for the first signs of a bounce starting and play off of that low for what ultimately should be corrective bounces, but those could be pretty aggressive jumps that then end up getting sold off after they complete their upside move. But some of those might be some of the best trades to be had over the next decade, as opposed to the boring just trying to move your stops down on a couple of short plays or longer term put spreads.
Thank you for that answer. Unfortunately, we are out of time. We did have a couple we couldn't get to, so I'm not sure if Zach and Garrett, if you had any contact information you wanted to share, if people wanted to reach out and ask you some questions.
We have free trials available for all of the services at elliottwavetrader.net. We also have some of our services are offered on Seeking Alpha. You can find Garrett and I both on Twitter. It's at ZACMANNES and at Garrett Patton. That's 2 R's and 2 T's, and then 2 T's again for Patton. But certainly you can find the links to make sure it's us on Twitter, because there are a lot of people that try to impersonate us.
Yes, there are. So thank you again for your presentation, Zach and Garrett, and thank you to our audience for joining us today. We have more sessions tomorrow, so make sure you tune in.
Thank you so much for hosting us.